Nice. Hi everyone. My name is Michael, and here with Larry. This is the Capital Canvas Pod. Just a bit of intro since this is our first episode. Um, Larry and I, late last year we started getting together, having long conversations about finance, business, tech, um, and career, of course. And it was, they were very good, insightful conversations. I always left feeling, like I learned more than one thing. And I felt like, they were good enough to, put out there. And, Larry and I sort of spoke about this and thought, yeah, maybe it was time to start sharing this stuff. Larry, I mean, w- we spoke about this widely, but yeah, what are your views?
No, that's exactly right. We've had numerous conversations on this topic. And I think one other thing for me is the number of people that actually don't know how to invest or even know where to start or what to go, how to go about it. I was speaking to a friend last year and he actually has never, he doesn't invest. His money stays in his checking account. He doesn't even put it in the savings account to earn the tiny 2% interest.
Mm,
I mean, I've had several of those kind of conversations, and I just thought it makes sense for people in our community to actually participate in the stock market. I know, like most times, there's this conversation around, um, the rich getting richer and things like that. And the fundamental reason why that is a lot of their wealth is held in equities.
mm.
So it makes sense. I just thought it makes sense for us to have these conversations openly and have people benefit from those conversations and try to maybe guide people to some extent on how to go
Yeah,
about it such that they're not scared. I think one of the problems is people are so scared. It feels like it's almost like you're gambling and you're going to lose all your money.
yeah.
So trying to put a bit of structure around it and see how people are going to respond to it and taking action and making investments on their own.
Yeah, yeah,
Yeah.
for sure, for sure. I think personal story like early days in the NBA, speaking to you gave me a lot of like courage, to start my own investing journey. It's been how many years now? 4 years, thereabout,
Then
three?
yeah, 22. Yeah, so
Yeah,
3 years.
yeah, 3 years, and it's been fun. I've made money. I'm not gonna lie. So yeah, why not share the news out there and let others learn as well.
Yeah, 100%.
Cool. Let's get to it. Like lots to talk about today. I'm looking forward to tomorrow. It's been a hell of a couple of weeks.
Oh God.
And the market is spicy right now. I mean, how you feeling?
Tell me about it. Look, the market has been crazy, and I think majority of that craziness has been driven by tariffs, right?
Mm,
And I mean, as every single time that you think, oh, maybe we've hit the end at the end of this, and we have some respite, somebody comes out and says something about tariffs. So maybe to kind of preface and kind of help people understand, right? Let's just walk through the journey of how the tariff has been introduced in different sectors, right? From the 1st of February, they introduced tariffs on Canada and Mexico. And then 2 days later, Trump then says, you know what, actually, maybe this is too sudden. We're going to postpone it by 30 days, right? So they put a placeholder on it for 30 days, which will essentially mean maybe on the 4th and 3rd or 4th of March, it will come into effect. Now, on the 10th of February, we got another shock, 25% on aluminum and steel imports, right? And then for the next couple of weeks, nothing really happened. And then all of a sudden, 4th of March, we come out and then it says the tariff that was supposed to be imposed that was pushed 30 days will go into effect. However, it then delayed 25% on aluminum and steel on Mexico and Canada. What did Canada do? Canada retaliated and said, you know what, I'm going to put 25% on $155 billion worth of goods. And then in 2 days later, Trump then responds and says, you know what, we're going to backtrack on this 25% on the Canada tariffs. That's just 2 days after Canada retaliated, by the way.
mm,
And then for the next couple of weeks, nothing really happened. And I guess he just got bored and then came out again and said, you know what, 24%, I mean, he's going to put on tariffs on anyone who buys Venezuelan oil. And then the market responds by sliding 3 straight days, right? And then as it starts to go up, then comes the sledgehammer. That's the one where it just imposes tariff on almost every country on earth, right? So between like 10 to 50% tariffs on 185 countries. and then a universal baseline of 10% tariffs on every country, and then 25% on foreign made autos, right? How
Hmm.
did the market respond? 5% drop the next day,
Yeah.
6% drop the day after that, and it was just downward spiral from then. Because again, on the 4th of April, China responded, imposing another 34% retaliatory tariffs on the US. And I mean, it just kept going on. And now I think what China is probably charging, I think 125%, and US is doing 145% on Chinese imports.
Mm.
So I think, and this is a bit connected to where we're probably going to go after this. But on the 9th of April, because of the crazy uncertainty, the pressure from business leaders and talking heads on Twitter, on X, on all news channels, all of a sudden we had a publication that said 90-day pause on other countries, excluding China, by the way. So China's tariff will still stay in place, and then other countries will have a pause for the next 90 days. And the market, that was great news for the market. Market went up, S&P, I think, went up by 9.5%. The NASDAQ, QQQ went up, I don't know, over 10%, right?
Mhm.
So, I mean, it has just kind of lent its way to the fact that, there's been a lot of uncertainty in the market. And the question you then ask yourself is, why is somebody creating this most chaos in the market,
Yeah.
right? And there's been like four fundamental reasons why people have said. One is to raise revenue. Two is to balance the budget because they currently have a $2 trillion annual budget deficit. Three is to reshore manufacturing. And then four is to renegotiate trade terms with other countries, right? Now, if you stick with the first, which is to raise revenue, the US currently has $36 trillion in debt, $2 trillion in annual budget deficit. And the way the Trump administration has said they're going to go about it is to increase revenue by 1 trillion and then reduce spending by 1 trillion, right? Now, reducing spending by 1 trillion is in the remit of Doge and Elon. And then increasing revenue is then in the hands of the Commerce Secretary, Lutnick. And the way that he has thought to do that is to say, we're going to issue these gold cards, which is like, I think $5 million, and then it gives you some sort of residence in the US, and also to raise revenues, right? So that's what tariffs then comes in to raise revenues. The second thing would then be the bond market. And so of the $36 trillion in debt that the US has, about 9 trillion of that is becoming due for refinancing this year. Now, if you want to refinance your debts, the way to do it is to do it with lower interest rates, right? If you're the US. Because right now they pay, I think, about $1 trillion in interest payments every year. So the way to reduce interest rates is to drive down the yield, right? To drive down the
Yep.
yield, you need to increase demand. To increase demand, you need to push people out of the stock market and let them search for safer securities.
Mm.
Now, how do you push people out of the stock market? Well, you can easily just crash it, and then everybody's scared, they panic, leverage funds, liquidate, and just go into safety. And even Warren Buffett has over $3 billion in treasuries, in cash. So I think that has been one of the conversations that people have had that is probably happening. And I think that can be further even supported with the idea of, if you look at the treasury bond yield, so in like May, in like March, we're probably getting very close to 4%. And since the market started to crash, it has gone down up until I think about just under 3.9%, right? On the 6th of April. Now, then all of a sudden it starts to spike again. And then this spike has kind of been attributed to maybe a potential someone who is holding US debt who is selling. And
Mm.
people are speculating that it is China that is selling their US debts, right? So that is then having an adverse effect on the yield. And then all of a sudden, the yield is then going up, right? And then when you see on the 9th of April, right, when this yield now spikes to a different level, all of a sudden, that was the same day, 9th of April. that Trump then issued the 90-day pause. So some people are speculating that it is probably because of the pressure on the yield that is driving this, right? So, I mean, at the end of the day, I think this is probably one of the most important reasons why is going, flip-flopping on these tariff issues. And I think the third thing, which is reshoring of manufacturing, I do not think that that is going to happen at any interesting pace to I mean, I guess he's probably doing it because he really believes in it, not because he wants to get credit for it in the short term while in office. But
Of course.
um, I think when you think about how long it would take for you to reshore manufacturing, to get land, to get plants, to start operations, I just don't think it's very realistic. And I think the broad way that they're going about it doesn't even work. I think you have to eventually say, you know what, these are the strategic industries, these are the things that matter the most, and these are the things I want to bring back. Not a blanket tariffs to bring all sort of manufacturing back into the US, you know. So, and then the third thing is to renegotiate the fees that, the tariffs that other countries are imposing on US imports. So, I mean, there are quite a number of countries that have already responded to that, and they have already said, you know what, like Israel, Taiwan, Vietnam, they're already saying, look, we are open to actually putting zero tariffs on US exports, right? So, I mean, I think at the end of the day, it's quite an interesting space. I think there's a lot of conjecture that can be made. There's a lot of assumptions. No one really knows. I don't even think the administration knows what they're doing, to be honest. Um, so I think eventually, hopefully, we have some level of certainty in the market.
Mm,
Um, and then we'll see how that goes really. But I think
yeah.
one thing that is also very interesting in all of this situation and everything that's going on is how much market manipulation may have been happening. Um, and I'm just curious, like, what have you seen? I know I've seen some things, but I want to hear your thoughts.
Yeah, I mean, it's crazy, like you said, like the market doesn't like uncertainty, right? And that's what's driving the madness right now in the markets. But I think before we get to the point of manipulation, we can't talk about manipulation without talking about the rally. Um,
Yeah,
Wednesday was a historic day in the US in the US stock markets. Lots of headlines. I think that Wednesday was when, like you said, Trump announced the 90-day pause of the tariffs on all countries besides China, of course. And a few things happened. It was crazy reactions across board from the stock market. The S&P had been falling. It's been on a free fall, prior to that pause. Um, Lost what? Nasdaq had lost 23% of its all-time highs. S&P was pretty much beaten down as well. And after that announcement, what happened? S&P jumped 9.5% in a single day. That's the highest single day return in 17 years. Um, you know, um, and so we keep saying, which is one of the reasons why we started this sport. You need to be in that market. If you had been buying through that, madness, you would have enjoyed, that single day of, crazy return. S&P was up, what, 12 points, what, about over 12% in a single day. Highest in single day return sorry, Nasdaq was up 12%, highest
yeah,
single day return for Nasdaq since 2001. And I think one of the things that was funny when you were speaking was through all of this madness, when the stock market is doing poorly, or when you're having a rout in the stock markets, the treasuries would normally, you know, um, react differently. But this time around, it's craziness across both treasuries and stock. But to speak about manipulation, so what had happened was Donald Trump had the cabinet had been going to interviews, with news and business channels, and they've been saying nothing is going to happen. We are pushing ahead with this tariff. And all of a sudden, we got this tweet from, Donald Trump. This is a
Now
perfect.
is
Now
this
it's the
now is
time
the
to
real time
buy,
to buy.
and he's signed off. You know, he signed off DJT on that tweet. I'm like, okay, something must be happening here. You know, that tweet kept flying, flying all around. People, the options market went crazy. You know, people bought options, 1,000, calls. And I think around 4 p.m., just a few hours after, that tweet, Trump announced a 90-day pause and everything just,
Yeah.
went
The
crazy.
$1,000 call pre posting that screenshot from Truth Social
Yeah,
can give you, I think, $1 million in the options
imagine.
market. It was insane.
Imagine,
Yeah.
imagine you had $1,000 to spare and you bought you bought call options in the US, and a few hours later you're looking at the bank and you're
0 day
seeing
to expiry. Yeah, that would have been.
nine 900K. Yeah, but so I mean, there's a lot of calls around the ethics of what Trump did with the announcements. People like AOC and several other politicians are saying what he did was manipulation of the market, because there was also this video that was flying around where Trump had brought a few people
That
into
was
the Oval
throw up.
Office,
Yeah.
and they were talking about how much they've made since the announcement. And you would agree, with some of those folks that, that it's not the tidiest way to do this. So this is Trump's tweets on that day. Um 3.9 million views from one tweet. And you would agree with some of these people that, when you tweet to the market before making announcements and advise people to buy, but then you also bring people to your office and you're telling them all these things around, how much money they've made. It doesn't speak well. This, if you were in business and you had done something like this, right, with your
Mhm.
company, you definitely are going to jail. There is no question around it.
Yeah.
But
There'll
but
be
it's not.
insider trading.
Yeah, that's insider trading
Business.
allegation straight away. It's evidence, how they. But the question is, it's a different landscape, right? This is politics, and there are no. I don't think America has got a law that precludes politicians from sharing, stuff that is going to happen, even though it has market impact. The Congress has been benefiting from. There are trades that are dedicated to following the Congress men and women of the U.S. Nancy Pelosi is, one of the biggest legend out there. I'm always looking forward to the next. What's the filing that they normally you have this filing where they declare their trades.
Yeah.
People wait. The second that thing drops, people are on, and releasing videos here and there, and they actually trade around, information that they have that is potent that would affect the stock market. So it's hypocritical for one side of the aisle to start calling on Trump or
Yeah.
start making allegations about this or that trade. I think there needs to be a law that actually catches all politicians, and that precludes them from actually using this information. Same as business, you shouldn't go into politics to enrich yourself. You're serving the people, and I don't think that's ethical. But the jury is out there. I'm not a judge, so yeah,
Mm. No, there's clearly um valid reasons for questioning some of these trades.
yeah,
And I think the one that kind of did it for me was the Oval Office one, where
yep.
it's like, oh yeah, you congratulations, you made $3 billion today. And it's like, what? Did these people have a conversation before it was made public? And I think
Yeah.
maybe some sort of safe place for them would be, oh well, I told everybody. Yeah, I
Mm,
put it out there. I sent the tweet to
mm,
everybody. I didn't tell just a select few. I mean,
yep.
but I mean, I think looking forward,
Yeah. How are you seeing the market play out tomorrow? The futures are looking bubbly. People are,
yeah,
yeah, waiting for some news to just ship the
yeah,
market.
the tomorrow is a bit tricky because I think on Saturday yesterday they came out with an exemption for smartphones, computers, solar panels, chips, which is like
Mm,
semiconductors and things like that. But today, the Commerce Secretary, our Lotnik, on TV did mention again that um those exemptions are temporary. And the exemptions is not because they just want to exempt all those things, because they want to create a separate category for them.
Mm.
And it's just like, why is there so much flip-flop on this tariff? Like, why can't we be sure? And guess what? Even guess what, right? There are some, I think there were some representative in the White House has then come out to say after that, well, I think Lotnick is going off script.
Oh,
We don't
really?
really know what he's talking about. And I'm like, can we just get some certainty in this market?
It's craziness. It's craziness
I
out
mean,
there.
it's like it's the most ridiculous thing that I've ever seen. I don't think I've ever seen this much chaos in economic policies in a country like America.
Yeah.
I don't think I've seen this. This is crazy.
Have you seen this? So this is Trump,
When did he say this?
sometime this afternoon actually.
Nobody's getting off the hook.
Yeah. And so it's actually saying, yeah, like there's no exemption anywhere. So yeah, I think this is the thing, right? Like there's just so much uncertainty, and I think this is why it's bad for the market because no one knows what's going on. There's
What
not a
is
coherent
happening?
plan,
Yeah.
you know. Um, yeah, so this was what just before 3 p.m. today.
Yeah. Wow.
Yesterday actually. Yeah.
So I think no, this was today. So I think
Mhm.
this is the problem. The level of uncertainty is just ridiculous.
Mm,
But I think ultimately you can almost think of it as though there are like two aspects to this, right? There are things that you can say, well, has been de-escalated over time from where we were like a couple of weeks ago. So for
hmm
instance, right now there's at least a pause on those items. Whether or not they're going to reintroduce it later, there's a pause, and
mm,
then conversations and negotiations can then happen. There's also the possibility that the Fed will cut interest rates in the next FOMC meeting. And that is because inflation dropped from 2.8% to I think 2.4%, like
yeah, cost CPI. Yeah.
yeah, CPI. So, and again, the long-term target for the Fed CP inflation rate is 2%. So if we're at
Mhm.
2.4% and it dropped 0.4%, then maybe we're getting closer to that.
Now let me counter that. So that's a good thing. Like, I'm waiting for that drop, by the way, man. I'm so waiting for it. But there's other school of thoughts that the recent tariff, that number one, that data is still, it's at least 1 month old. Then the recent tariffs would also cause also expected to cause
Correct.
rising prices, and so you're going to see a reversal of that trend with CPI the next couple of weeks. But yeah. Don't hold me to that.
No. That's a valid point, and I think Jerome Powell, who is the Fed chair, shared that same sentiment the last time he spoke.
Mm,
And then Trump was trying to put him under pressure to say, look, why not just cut rates? Inflation is coming down, cut rates.
mm,
And Jerome Powell's response was, I can't cut rates yet. We are still trying to model out and see the implications of tariffs on prices. And as you
mm,
know, the two fundamental objectives of the Fed is one, price stability, and
hmm
two, low unemployment, right?
Yep, yep.
So maximum employment. And what price stability really means is fighting inflation at all costs, even at the cost of a recession. So
Mm,
Trump and the federal government might be worried about a recession and they don't want that. But for Jerome Powell, who is independent of the federal government, as it should be, his goal is to fight inflation. And sometimes that will mean getting plunging the economy into a recession. And they don't mind that.
mm,
They've done that in the past.
mm,
So that is going to happen. There's optimism that there's going to be a rate cut in the next couple months. And look, interest rate is so important. Well, number one is important because when interest rate goes down, people are more likely to borrow and
mm.
incur credit card debt.
Yep.
And then as a result of that, then spend money and buying things from corporations that then increases their revenue, right? So there's a direct correlation between spend or revenue from for corporations and then interest rates. Another thing is that it also reduces borrowing costs. So a cost on your books is interest cost. So when you reduce interest costs, all of a sudden your net profits goes up.
Yep.
And that forms part of increment in valuation. And then the last and maybe even the most important one is then if you think about valuation, right, they're discounting future cash flows to present day, right? And the rates that you're using to discount as the discount rate. And your discount rate is the interest rates that the Fed sets is a function of your discount rate. Your discount rate is a
Mm.
function of that. So at the end of the day, if you reduce the Fed rate, all of a sudden now you're discounting it at the lower discount rate, and then you have higher valuations in present day. So
Mm.
the interest rate is extremely important. So I mean, there are good things that might happen, even though they're still a bit wobbly. Nothing is set in stone.
Mm.
But there are also risks. Now, the 90-day reprieve that we had is 90 days. And the more the days count, the more we get closer to that day. And then
Oh,
it's then a case of, okay, so what is he going
what
to
happens after that?
do?
Yeah.
So there's still that risk. There's also recession fears. I think JP Morgan currently has
Demon.
a projection of, I think, 0.5 or to 1% reduction in GDP. And I
Mm.
mean, the technical definition of a recession is, two consecutive quarters
Quarters.
of GDP decline.
Yep.
Even though we've kind of fiddled around with what recession really means. I remember the last time, I think 2022, and then they were like, it's not really a recession, even though we had two consecutive quarters of GDP decline because
Mm.
unemployment rates were low.
Mm.
So it's like, well, and you're already seeing that with Dalio, Jamie Dimon saying, well, the recession, who cares? We slow down by 0.5%, who cares? And it's like, okay, maybe we're actually going to get a recession, but no one is going to no one is going to care.
Yeah.
So yeah, I mean, there's a lot of risk, and even consumer spending is another thing. I think GDP of the US, I think 70% of that comes from consumer spending.
Mm.
So if consumer sentiment is down and they're not spending, then that has a significant impact on GDP as well. So that kind of amplifies the recession fears.
Mm.
So, I mean, at the end of the day, what I always say to people is there's always going to be a reason why you're not going to invest. Like, there's always going to be a reason, right? So I think what people should really be focused on would be um, what are my long-term goals in the stock market, right? And what are the things that matter the most, and not all this flip-flopping and things like that. So I mean, there's there's something that people always say about the stock market and how much it really doesn't matter everything that is going on, right? So there is always a reason to sell your stock, right? Now, if you
Yep.
look at the last couple of years, I think we've had almost 20 recessions, right? And every single time we've had recessions, we've had COVID, we've had a depression, economic crisis, we've had 9/11, wars, two world wars, we've had all these things. And the stock market has always gone up each time, right? So on this chart, it's just telling you, oh, there's Ebola virus, there's US election, futures fall 5%, trade wars, COVID, all these things. But guess what? We hit all-time highs in S&P 500 this year. I know it sounds like it's some 2 years ago, but we literally were all-time high this year. So I
Mm.
think the point is that there's always going to be a reason for you to sell your stock or not invest. But I think what the data really shows us is over time, the market just always goes up, right?
Yep.
Um, and I mean, and I think one of the probably another thing to kind of factor in and consider would be, how much, like what do you do in a time like this, right? In a
What's
time
your
like
playbook?
Say that again.
I was saying, what's your playbook? Yeah, in
Yeah,
times like
so
this.
in times like this, I think the probably the best thing to do will be to hedge. The next best thing to do will be to diversify and then maybe even hold cash, right?
Mhm.
Now, when I say hedge, there are several ways to hedge, but the one that I've kind of adopted is to buy put options, um, which is essentially saying, look, the market might go down, and I'm going to profit from the market actually going down. What that does is it puts a bit of a cap on your losses, right? So if you own stocks, right, in your basic portfolio, you own stocks, and then the value of that stock drops, and then those stocks are then very correlated with, say, S&P 500. You can hedge by buying put options on the S&P 500,
Mm.
such that the profit from that as your stock prices goes up. So it kind of limits your downside. Now, my caveat to that is if you've never bought or traded options before, now is not the right time to do it. Do not get into it. I think you probably should move to the next best thing, which is to diversify.
Yeah.
Um, but I think the problem is in a market like this, there's almost no hiding place.
Yeah. Yeah. I was gonna say maybe get into a bit of defensive stock, but yeah.
Yeah,
Uh, they've not been very defensive these days. Everything
there's
is
almost no hiding place, you know.
yeah.
So and this chart kind of puts it into perspective. In the last 6 months, almost every sector has been down except
Mm.
maybe utilities and healthcare, right? Which goes in line with what you've said, defensive stocks, right?
Yeah.
So in Canada, we've probably have about 21% up in the last 6 months on healthcare, basic material services, utilities, and technology. But in the US, you've had a bit more because the US is more tech heavy. So you've had in the last 6 months 6% down and things like that. So if you look at this chart, there's almost like only just three places to hide. And I mean, we might go through some of the other stocks or some of the assets to look at. But this just kind of puts into perspective how much how difficult it is to actually look for look for places to put your money these days because
Yeah.
everything is just down. Everything is down, right? So but this is just showing that there are still some sectors that you might be able to get some investment in and kind of hedge your book, if you will. And so in my playbook, it will be maybe utilities, healthcare, um, consumer staples, and things like that. And then there's a couple of names that I can share. So for utilities, you can go with the index XLU. For healthcare, you can go with the index XLV. And maybe we can share that in the chat. But so you can probably go through that route and maybe skew your investment more towards those defensive areas until this uncertainty that is just looming in the market kind of fades, and then we have some more clarity around what is going on in the market and things like that. So, I mean, it's and then maybe the last thing is cash.
Yep.
Cash is a bit tricky because it almost sounds like you are hoping to be able to time the bottom. And I don't think anyone can time the bottom. You might catch it close to the bottom, but you almost cannot, right? So there's always a risk of returns forgone by sitting on the sidelines for too long. Like the charts that I've shared earlier has kind of indicated, the market progressively over the last 100 years has gone up, and we've had all of this terrible and even worse things going on than what is going on right now.
Yep.
So, and maybe I could just share some of the way that I am thinking about investing. I mean, and this is my own way of thinking about it. Everybody's situation is different. So ultimately, it will make sense for you to do your own research, consider your own situation, and then decide on how you want to split this, right? So something that I do is to say, in times like this, by the way, so I'm saying I have this diversified and defensive ETFs, and then I have companies with less exposure to tariffs and China reliance, because right now tariffs is has been paused on every other country except China, with the exception of the 10% baseline for everybody. And then also high risk, high reward companies, right? So my current split is 70% to ETFs in one of my portfolios, and then 20% for companies that have limited Chinese exposure, and then maybe 10% to high risk, just in case the market starts to rip. So that's the way I'll think about it. And if you started your year with this kind of portfolio, you would be down 3.7% versus the 9.2% where the S&P is currently down. And you can already see that you have XLV, which is healthcare, 30% weight in your entire in that portfolio mix. XLU, which is defensive, has 10%, and VO, which is like the broad market that tracks the S&P 500, that you can put in like 20%. And then you also try to limit your exposure to China. So you can also split this 5% each for Microsoft. I mean, Microsoft is not prescriptive. You can pick other stocks, but preferably for me, I'm going with those that have like limited exposure to China. And then you have
Mm,
semiconductor stock and consumer staples. And then IRAs, you have like Palantir, the BOTZ that kind of tracks the robotics and AI, which is like the future. And you have Hood, which is Robin Hood, and then Oklo, which is like a nuclear energy company. So that's the way that I would really think about investing in this current climate. Now, this can change, and it can change very quickly, as we've seen with the 9% uptick in the stock market just by one tweet, right? So this can change very quickly. There will be need to rebalance depending on how things change. And now I do recognize that not everybody has the skill set to balance portfolios and do all those kind of fancy things. And sometimes people just wing it, right? So, but the great thing is that there are actually funds that have that actually do this balancing on your behalf. So you don't have to have the skill sets to do it. You can just invest in funds, and then they'll know what the right time is to get out of defensive and go more tech heavy or take more risk, and also just tailor it to your own risk tolerance level.
yeah.
So and maybe in subsequent episodes we can probably just share some of those managed funds and
Yeah, yeah, yeah. In the UK, I think Vanguard is the most popular one, and maybe
yeah,
across the
yeah.
world as well.
There
In
are
the
quite a
US,
number of them. Yeah.
they've
So
got several funds that track all of these sectors that you've talked about. So yeah,
yeah, and they can manage it. They'll do the rebalancing for you and things like
yeah,
that. So I mean, just so that is what I think in the short term. I guess maybe my question to you would then be, in the long term, just broadly speaking, let's say I've done, based on what I've shared, I've done my split and I say I want to go 60, 30, 10,
mm,
and I want to go 60% ETFs, S&P, defensive, whatever, tech. How do I, and then I want to focus on that 30%, which is picking specific names, right?
mm.
What's your kind of framework approach to deciding on what companies to pick?
Yeah. I mean, yeah. I mean, you said a lot of things that even I and I've learned from. I've spied a few of those calls that you've made there. Yeah, I'm gonna be researching some of those later on. But yeah, I keep it very, very simple to be honest. I think about it as normal research, and this is not financial advice. Everything we've said here today is not financial advice. You still need to do your research. Don't go and trade on those stocks, that you've seen there. You might get bonds. You need to be sure what you're investing in. But yeah, if so, for picking stock, right? Like I say, traditional research, there are two main approach to research. There's the qualitative research and there's the quantitative research. If you've gone to school at all, even if it's diploma, you would have learned how to do research, right? You would have had to do a project, and that project would have involved some research. And it's the same thing everywhere, qualitative and quantitative. Now with quantitative, I look, right? So I tend to usually have a team. So I think end of last year I was looking at robotics, for example. And I listed out all the robotic stock that I could find, right? And then I started looking at them one after the other. So let's go through how I looked at them. So I would look at them on a quant side first, right? To screen them and take out the weed, and then I'll go to the qualitative aspects. When I'm looking at the quant aspect of the stock, obviously I look at the revenue. Let me share my screen to just like a walkthrough
Yeah.
of some of the things I look at. And you need to decide. It's very, very research heavy, like we say. There's no shortcut to it, unfortunately. You need to unfortunately, you need to put in lots of hours. You need to be sure that you really want to do this. Otherwise, like Larry said, just invest in ETFs and manage funds. Now, so let's let me look for a very, very common one that people would normally invest in. Let's look at Google, right? Let's look at Alphabet. Now, so if I was researching Alphabet, I would, you can use any tool, by the way. This is not an advert for this, platform. It's just the easiest platform that I use right now. You can use lots of free platform out there.
Well, maybe they
I
can
think,
sponsor us, you know?
yeah, maybe, yeah, stock analysis, open for sponsorship here. So, I mean, I'll just really come here. As you can see, this company what had 182 billion in 2020, and their last results they've grown that to 350 billion. This is in what,
Google's
5 years?
growth
That
is insane.
that is a massive run. Do you
Insane.
understand? So you don't need a pastor to tell you that this is a this is a growth story. So when you see this company making up 7% of maybe the Nasdaq, for example, I'm not sure if that's correct by the way, but you can already tell that this is why they are there. They are high growth. Now, so I look at these, I'm like, okay, revenue looks stable. It looks to be growing, and it looks like they're managing their cost as well. If I'm not comfortable, I look a bit deeper into the financials. I look at it, oh, it looks like, this is all green. Revenue growth year on year looks, to be consistently green. I then go straight to the gross profit. This company is turning out gross profits. I look at operating profits, which, looks at things like that take accounts of R&D, operations expense, advertising expense. Even after that, they're still pushing out chunky amounts, of operating income. I then go straight most times to EBITDA, just to see if there's any sort of accounting gymnastic going on there. But you can see consistently it's above 30%. So this is a very, you can tell that the management of this company is very, very disciplined. They are disciplined allocators of, capital. So if you had a very chunky amount of your money here, if you're talking 30% and you want to invest in say five stock, you can tell that this company knows what they're doing, right? And then you can be comfortable keeping your money there. And so when I'm done with, sort of these financial quant aspects, I go to like very basic metrics, right? There are lots of them, right? There is no fast rule, but there are some of them that definitely you need to look at. Let's go to statistics. I'll look at the PE. And when you're looking at PE, this is when you've shortlisted a few stock. You can't just look at P. PE, by the way, means price earning ratio. This is a ratio of this is how much you're paying for the company, right? Versus the earnings that the company actually provides. You can't look at this in isolation. You need to look at this in relative to the industry, to compare it to comparable companies like say Amazon and um, and maybe companies like Tesla, you would also consider high
Yeah,
growth.
Mike
You sort of,
Seven.
yeah, you sort of compare all of these PE for these companies. There are many other things I look at like ROC, which is return on capital expenditure. I look at what are the other things you look at, Larry, on your side when you're looking at quants? I know you look at beta, right? You look at beta to actually
Yeah,
see the risk. So this is beta here. You look at the 5-year beta. Um,
yeah. I like to know what I'm very PE heavy. I think one of the things that I've kind of figured out over time is that for you to do, there are many valuation techniques to adopt, right? There's the DCF, which is discounted cash flow. You're looking into the future, 5 years, 10 years, depending on the industry, projecting the cash flows and then discounting it to present day. Now, that approach to me, it's flawed in that I don't think anyone knows what the earnings of a company will be in the next 10 years.
Yep.
I think at best, especially when you're dealing with disruptive technology, so I tend to focus on next year and then apply multiples based on long-term interest rates, based on the growth rate of earnings. So for me, PE ratio is the most important thing. And a
Yep.
component of that would be the discount rates, the interest rates, and the growth rates of the company's earnings.
Yep.
So I like to do that because the truth is I can come up here and talk about I think this company is going to grow by 30% CAGR in the next 5 years. But I mean that's a very broad assumption. I'd rather focus on the next year, so your forward earnings, and then apply a PE multiple on that based on current market conditions. Is how
Yep.
I like to think about it. And I mean there are many other things that I like to consider. Just like the quality of the management and things like that. So,
Yeah. Yeah.
but yeah,
That's on the qualitative side. So before we
yeah.
go into qualitative, like one thing I like to look at is also PEG ratio to just see, the growth rate of the PE ratio as well. I think when I'm then looking at, say, qualitative aspects, there are three main things I look at. The first one is the company's model. So what's the business model of this company? How do they make their money? For example, when you're looking at Netflix, you're looking at subscription, right? It's a very, very defined model. When you're looking at Amazon, for example, you're looking at there are a few things that you need to understand with Amazon. So Amazon has got what? They've got their own products, but they've also got a marketplace where people actually sell their stuff, right? So if I'm thinking, I know that the people who sell stuff on Amazon pay Amazon, but Amazon also has their own stuff that they sell, so they make money from their retail. I know that people sell on Amazon also do advertisements on Amazon, so they generate a very high, advertising revenue, more than people actually think they do. So I look at how they actually make money. So a very good way to do that is, like I say again, this tool is not special in any way. You can get this from many, many companies, many platforms. So if I'm looking at how they are making money, by the way, I tend to just go here. I look at what are their various segments, right? Beyond the model and how that model works, I just look at the segments. What is actually driving their revenue? So for Google, for example, you can see search is one of the, if I remove search, this drops quite substantially, right? So search is very, very heavy in terms of the constituent of
This is
Google's
very
revenue.
interesting, by the way. I mean,
Yeah.
I think what I've heard people tell me over the last couple of years and months is with the introduction of LLMs, people are going away from the traditional search on Google to actually using LLMs to do their initial search. And for that reason, Google's search business is under threat. Well, OpenAI has been around for the last couple of years. And I'm looking at this chart, right? From 2022, for instance, January
Hmm.
2022, I'm seeing 149 billion. And this has grown progressively regardless,
Yep.
right? So, I mean, it's a bit interesting to me.
Yep.
And this is one of the reasons why I think Google is such a great business.
No, it
Um,
is.
I
It
think,
is.
yes, you're right. Like the quality of management is absolutely important.
Yep.
There is no business that is not going to be faced with competition, especially when you have great business, great margin. People are always going to try to eat your lunch. But
Yep.
I think what kind of helps you get past that is the quality of management, the quality of the team,
Yep.
their ability to execute and turn around really quickly. And I think Google just, I mean, they've been kind of criticized for a while for being too slow, for being too bureaucratic, maybe because they've just become too big and less innovative compared to their peers. But I think now that you can see the competition right now, their co-founders are coming back to the business and getting more
Yeah,
active, and it's like,
yeah.
it's time to go again.
It's time to go again. Next
So
next cycle, next wave is here. Let's give it
yeah,
another
so I
run.
mean,
Yeah.
I like this. This is quite
Yeah.
interesting. Yeah.
Yeah. So I mean, yeah, so that's it, right? So I think the third thing I look at, you've mentioned quality of management. I absolutely always look at that. I go as far as, by the way, which is very funny, going to LinkedIn. If I'm investing in a small cap, Larry has seen me
Okay.
do it before. I literally go to LinkedIn, check the board directors, check everyone. Man, if I'm giving you my 5 grand, which is my, that's a decent chunk of my, my salary. So I need to know if you're gonna fuck it up. So yeah, I go to LinkedIn, I go to Wikipedia, for example, just Google, who those people are and read everything about them. The last thing that Larry is already sort of touching on here is the moats. What's your competitive advantage? That's the third thing I look at. So when I look at Google, Google is not just a business, it's a verb. They created a verb. So people now use it as a verb. And that's what ChatGPT is trying to do now. They're almost becoming a verb as well. And kudos to them. The team has done, incredibly well. But yeah, this Google business has just got a moat. They've got a pathway into people's mind such that you can't live without them. So even when a creative and wonderful product like ChatGPT comes, you just always revert back to them. It's your gateway to the internet. And for me, that is a moat that, is irreplaceable, right? Regardless of what AI, tool and model comes
Yeah.
tomorrow. And you see, when you think about moats, me and Larry we've had multiple conversations around this, and the way that people are trying to, enter into AI, LLMs, there are companies that have got moats. So when you look at Meta, for example, they've got Instagram, for the younger generation. They've got Facebook that continue to be used by, the boomers. They've then got WhatsApp that is used by all. And then, they've started doing, they introduced their Llama recently. And how did they introduce Llama? It was a very quiet launch. They tapped into their what? How many millions of WhatsApp users are there in the world? I can't even say.
Yeah. Billions.
And yeah, automatically, those billions of people that use WhatsApp in the world became instantly active users of Llama. And for me, that is a moat that, you can't replace. And so those are the sort of things that you need to think about when you're thinking about qualitative, analysis. And yeah, it's not just for digital companies that you can do this for. You can do it for, companies like Celsius that really just do a drink. And you see how sticky the product is, how sticky their products are, and whether people keep going back, to spend their cash on those products. So, yeah. So that's my simple technique. But yeah, like I said, it requires lots of research. You need to be intentional with what you're doing. You can't just it's your money, right? Like if it's also the stock market is very, very risky, so you can't just
Yeah.
um take it lightly.
Oh yeah, absolutely. And I think maybe to kind of put into perspective, and again, maybe going back to that conversation of what is going on right now, and maybe give people a little bit of comfort of understanding that what is going on right now, the driver might be different, but the outcome is not any different. We've been through this before. Um, and I think maybe a good way to kind of demonstrate that would be to share what has happened in 2022. So in 2022, we had a bear market, right? We're coming out of COVID where we essentially issued $1.9 trillion in stimulus checks. We were riding on inflation of, I think, 9.1%. The Fed had hiked interest rates to, I think, about 4.8%. We also had supply chain shocks to like semiconductors that goes into cars, and people like that could not create. So we had a supply chain driven inflation, hike. And then we also had, I think, Russia's invasion of Ukraine, which has affected oil prices. So we had so many things going on, and I feel like it's even more complex because you can't snap your fingers and change the narrative. In this
Mm,
current time, climates, You can just wake up tomorrow, Trump stops this flip-flopping on tariffs, and then we're back to normal. Now, is that going to happen? I don't know. But I think in 2022, when you look at the comparison of the Mark 7, Mark 7 is like the largest, one of some of the largest tech stocks in the US. Then it's Amazon, Microsoft, Google, Apple, Meta, Nvidia, and Tesla.
Yep.
So if you look at the average of the multiples, this is the price to earnings multiple that Mike kind of explained earlier, which helps you value companies. If you look at the 21 to 24 average, and then you compare it to 2022, you can just see that the multiples got depleted, right? And that is partly because one, you're going to slow down your growth because of the recession. Two, we also had high interest rates, right? So Google was trading at 19 times revenue, 19 times earnings in 2022. And that average is like 23x for those 4 years, right? Same thing for Apple. It was trading at 23. The average was 29. Meta was trading at 14. Meta got really hammered that period. I think it went to a low of like $82. And right now it's at 500 and something. So you could easily have 5x your money by investing in those times. So I think the message here is there's always going to be opportunities to get into the market. And I know it's counterintuitive. It's like, are you asking me to buy stocks when everything is tanking? So,
But Larry, that's the thing, right? So I think that's the thing I forgot to touch on. There are two other things that besides qualitative and quantitative, and those things that we spoke about. There is two things: discipline
the
and
psychology.
trading psychology, right? So even though you're an investor, I think there are some, even though you're a long-term investor, you also don't want to you want to have a very good entry point into the market. And there's something that
Oh,
you
yeah.
always tell me, but Warren Buffett also says it. What is most important is how much you bought the stock. Did you buy at the best discounts? If have you hunted for the discount? Are you sure that you've actually hunted? So when we say you do your call and you do your quants, we've not just say okay, then just buy it.
Then just go
There's
and buy, click the
yeah,
button.
there's a bit of technical analysis. And when you were talking about DCA, sorry, DCF, I was quite conscious that many of the people or the audience of this show might not understand what those things are. It might be a bit too technical. We don't need you to actually know what those things are. Like PE is very, very easy to access. You can actually check out the PE companies for all the companies in the world via Google because it shows you how costly or how expensive those stocks are relative to the market and their peers, right? So you know
Relative
how
to the
much of a
market, their
discount
peers, the
and
historical average.
historical, yeah.
Yeah,
So those are the exercises that you need to do, and there's no structure around this exercise. You basically can develop your own framework of how you want to do it.
absolutely.
But to talk about trading psychology, there's something called technical analysis that Larry also seriously looks at, which helps him get the best price possible. If you understand what people are doing, so now that you understand what is going on now, you know this is when people are selling, and so automatically, as you need to be able to think in a way that is counterintuitive to people. So people are running away. You need to be saying there is an opportunity here.
Correct.
And is that opportunity strong enough for me to then jump into the market? You need to be able to, so this is not timing the market, right? This is you. So we are not saying you should only buy stock this time. We're just saying if you've not bought stock before, if you've not been investing, it's a perfect time to start looking. If you've been doing investing for a while, it's also a perfect time to maybe do your dollar cost averaging. There are people who do end of the month. Well, personally, I find that if you're doing end of the month at a fixed time, you're not milking the opportunity, right? You need to then set aside some cash to say, okay, am I getting the best discount right now? And then, know when to pull the trigger
Yeah,
for
dollar
some
cost
stock.
average is beneficial in the bear market.
Yep.
The idea of dollar cost average, maybe to kind of address that, you're not
Yep.
trying to optimize your return, right? You're trying to help your psychology, train your mind to do
Mm-hmm.
something repetitively over time, right? If you're in a bull market, you're better off putting, if say you have 10,000, you have $12,000 to deploy in a given year. If you're in a bull market, you're better off putting that $12,000 at the start of the year, right? Such that you get all the gain that comes in that bull year,
Mm.
right? Versus if say you put only 1,000, so the first month only a portion of the 12,000, which is just the 1,000, will benefit from that gain. If you're in the bear market, the reverse is the case. So you're better off averaging down, and instead of suffering the entire drawdown in your portfolio, starting from your total equity investment, you're better off investing in bits, right? Now, the problem is you're probably not going to know whether you're in a bear or a bull market. So and like I always say, in the absence of a differentiated opinion, the next best free lunch really is diversification. And I think DCA kind of helps you do that as well, especially when you're doing it with like an index. So I mean, DCA is great if you cannot tell whether we're in a bear or the bull market.
Yep.
Just DCA continuously. But sometimes, so for people who are more experienced and more skilled, there are technical indicators, there are economic indicators that you can use to determine, are we heading into a recession? Is there going to be a bear market? Things like that. And then you can decide, am I going in heavy at this point, or am I just, averaging down and things like that. So in market like this, we've definitely been in and out of like bear territory. So if you think this is a bear market, for instance, you're better off averaging down. So if you buy now and it tanks for that, only a portion of your total investment in that year will tank, and then you can invest it at a lower price, and then at the lower price if it keeps tanking and things like that. So yeah, DCA does have a lot of value for sure.
Yep. Yep. It's good. Yeah.
Yeah.
So I think last point before we call it a day, what are the do's and don'ts that you would what are your top lists for do's and don'ts in the market?
Um, I think one that I've kind of shared earlier, but I'll say it again is don't do anything new that you haven't done before.
Mm.
Like, don't try to go buy options now when you haven't bought options.
Mhm.
Because then there's a whole lot of things that you need to understand. You need to understand your theta, your delta, all the Greeks, implied volatility, and things like that. So, like, don't try to do anything crazy. Don't go around chasing. I mean, that's the first thing. The second thing I would say is don't go around chasing 100x opportunities with
Mm.
the entire value of your portfolio. I mean, I always tell you, in times like this, I hardly touch companies that are loss making. Except I want to put it in a speculative market and you form only a fraction of that,
Yep.
of that share. So I would look at really great companies. I think you shared Google. I personally think Google is a great company. I kind of shared the PE the other time. Let me see if I can share that again. Yeah, so based on current price, Google is currently trading at 17 times earnings. That's the PE multiple. And the historical average is 23. So that shows me there's a lot of upside there. And then based on the estimated EPS by Wall Street, right? This is the estimated price using the average. So if you assume that this 2025 estimates kind of reverts to the average, to the long-term average or the last 4 years average, then this will be the price using Wall Street EPS estimates, right? And then you just have all the upside here. And of course, like, there's no guarantee that any of this is going to happen. There's also a risk to all of these EPS estimates. If we get into a recession and people try to cut capital spend, cheap companies might suffer a bit more. If people start to cut ad spend, companies like Meta and Google that are heavy on ads revenue might suffer. So there's still a lot of risk with that. But I think if you're a long-term investor, you're trying to invest for the long term. You're not trying to get in and out of the market in the next 3 to 6 months. then I think there's some of these names that are looking really interesting.
Yeah.
For me, I just keep looking at Nvidia and you know, I just can't understand why why they're attrining a 20x revenue. I mean, multiple to a company that is about to double its earnings. So I
Mm.
guess the long-term growth rate might be a factor.
Yeah.
There might
It's
be
crazy.
there might be some.
Nvidia, I just spotted Nvidia there. I wasn't even so in 2022, Nvidia was trading 115 times P.
Yep.
Wow.
So it's definitely an interesting way to look at it, but I think that there are some really very good names. You don't have to go into like very risky companies to get upside here. There's a lot of great names that have been depleted already,
Mm.
that I'll certainly be looking at. So I mean, those are like the two fundamental things that I would say people should do or not do.
Yeah.
Um, but yeah,
I think I've got two that
yeah, great.
yeah, that tends to be it's a framing that is very, very difficult, right? I don't know if it's a do or don't, but it's just something that I think that you need to, a way that you need to frame. And this is something that you do very well. I don't know how you do it, but it's something that even people who work in finance keep reminding themselves about is, and you see it in the caveats of many financial reports that you see, it's past results are not a guarantee for future performance, right? There's a variant of that that you see everywhere, even on finance and media. Well, it's not just a caveat, it's actually the right way to invest.
Okay.
When you're investing, you should, before when you're trying to make that decision of where to invest, you shouldn't be thinking about past results. You should be thinking about what is the future potential of this company. So when we are thinking about Tesla every single time, my default logic is just say, okay, well, I'm seeing the cannibalization of maybe not cannibalization, it's not I'm seeing the death of, Tesla cars, BYD is killing them everywhere. The brand is getting, depleted or decayed, or well, I'm not thinking about FSD and how that's getting better. I'm not thinking about the humanoids that are coming. And so the real investor that thinks long term is thinking about the future, right? But
Right.
human beings just tend to always think about the past. And it's the same thing with Google. You need to think about what can happen with AI and where can that sort of parachute Google to, rather than thinking, okay, how far has Google it's when you've then decided about the future and you say, okay, this company in under 3 years, it's gonna be, big. You can then start looking at past results. And when you look at past results, in my opinion, is what Larry has done there. You're looking at PE. Is this the right price to buy? Is it a good time to buy? So that's the first framing that I think people need to correct when they always think about yet to invest. Don't think about past, think about the future. The second one is people tend to sell their best performing stock only after 15% of profit.
Why you? I feel like you're speaking to me right now.
Like I'm talking to myself here, but this is what I'm saying, right? People don't let, and that's what I'm saying. Even
Let your winners ride.
yeah, let your winners ride, and it's so difficult to do. But you need to get it right. If you're not doing that, you're not going to make tangible money. You're going to make money. You're going to keep making
Yeah.
money. At the end of the year, you've done what? You've done 25%. S&P has done what? 10%. That's good. But some people are leaving this to run for like 3, 4 years, and they are what? 5x in that money, and you keep making 25,
Oh God. I'll
every
tell
two
you
years.
a very simple and quick story. So
Sorry, the flip of that, let me just finish
yeah,
that. The flip of that is people sell those winners after 15%. See, I'm not talking to you. I'm talking to myself.
you're talking to me, but go ahead.
People sell the winners after 20%. They're like, oh, 15, I've made money. I put in 10K, I have 1K, I'm good. And then do you know what they do with their losers?
They hold on to it, so
They
it's
oh no,
gonna come back.
man, this is me. This is so me. You
It's
need to see
yeah,
my portfolio is filled with
it's
relics of
reversed.
2022. But
Yeah.
what you need to do is to actually sell. You need to just be very, very disciplined. Okay, well, I've made a wrong call here. And this is where Larry always, he's got a good technique with capping is a risk. It's called risk management. Super important. I keep saying that, and you're like, okay, I've screwed up with this with my entry point, or you can't predict the market. The market has not gone to my favor. You need to close it and just keep the money and look for the next opportunity rather than holding on to it
You're
and
never gonna be
losing 70% and 50%.
exactly. You're gonna make mistakes. The best,
Yeah.
the best investors make mistakes.
Yep.
So don't beat yourself up thinking, oh my gosh, I don't know what I'm
If people are wondering, let me just quickly tell them. So I'm sure that I've not looked, but I'm sure that Google, maybe Uber, for example, would have fallen what 10% from when Bill Ackman invested what 20 billion. 10% of 20 billion is what? That's crazy money,
doing.
But
Yeah,
it's not pulled out. That's the sort of mentality you need to have to, to
yeah,
succeed in investing.
yeah. And I always tell people in the stock market, I look at profits as a number. I
Yep.
don't think of it as a percentage. The problem with thinking about it as a percentage is you would end up making very risky bets. So if I were to tell you, I have $10,000 to deploy, I want to put it in either Google or I put it in Oklo. Oklo is a nuclear energy company that nuclear energy in the US, it has not started. It's futuristic, right? Now, if I tell you how much are you comfortable putting in Google and how much are you comfortable putting in Oklo, I'm willing to bet that you might be willing to put your entire 10K in Google. Why? Because of all of the things that you've shared in your previous screen share there. Great company, growing revenue, 300 over 300 billion in revenue, dominance in search, all this exciting things going on in the future. They're getting into robotics, they're getting into way more self-driving, they have their own LLM, Gemini. So the past is great. They're maintaining that growth on the existing business, and they're also looking at new frontiers. So great company. I am comfortable. And when you look at the track record of the management, they've done most of the things that they said they were going to do in their earnings call or their publications and reports. So I have a lot of faith in the management. I'm comfortable. I can put my 10 grand. Good. Now, let's assume that it then does 15%, right? It means I've gotten 1,500, right? Now, if I were to tell you, well, there's this company, it started like 10 years ago, but they've actually never made any money, no revenue. They're still loss making. They don't even have all the approvals that they need to be able to execute on some of the things that they've promised. Of your $10,000, how much are you willing to put in it? You're probably gonna say maybe 5% of my money, so maybe 500 bucks or $1,000.
Hmm.
And then when you do that, say you then 2x your money,
Yep.
right? So you go from 500 to 1,000. So you've made 500 bucks, but I've made 1,500 in Google. So now let's even say, okay, you know what? I put $1,000 and then I 3x my money. All right. So you've gone from 1,000 to 3,000. So you've made 2,000. I would need to get only 20% return on Google to achieve this
To make the
potential,
same. Yeah.
right? So at the end of the day, your 3x opportunity without conviction, it doesn't really mean much to me, right? So I always favor going for stocks that I have conviction in versus
Mm.
stocks that are just mere speculation. Now, I do have space for speculation in my portfolio because I think why not, right? So if the 500 goes 20x for whatever reason, I want to be a part of that. But I'm only going to assign a smaller portion of my portfolio to that, right? So yeah, I always say like, for me, I think about profit as a number. And of course, it is a percentage.
Mm.
But when I'm trying to make an investment decision, it's about how much weight are you going to put in behind this stock or this asset, and I think that's like to me that's like a good way to think about it.
Mm.
And I mean, I just would rather have $2,000 from a 20% run than 300% from a $500 investment. I mean, The chances is, yeah, the odds are more in favor of the person doing the Google in this instance.
Yeah.
Yeah.
Yeah, it's been a beautiful conversation.
So one thing I wanted to also ask, and I mean, maybe we
Yeah.
can kind of turn this into like like a series to talk about what is going to happen going forward. You know, that's
Mm,
10% buckets of your entire portfolio where it's like high risk, high reward
mm,
kind of thing, next frontiers. I think there are like maybe 4 or 5 sectors like that. There's AI, there's energy, there's robotics, and then there's maybe quantum.
yep.
So maybe subsequently, we can have these conversations, look at the industry, what is changing, what is going on, what are the
Yep.
opportunities here, who are
Yep.
key players, how are they performing, what metrics are we looking out for, and things like that. And then
Hmm.
we can kind of just take it step by step, maybe go into AI, spread that out into subsectors, go into
Mm,
energy, do the same thing, robotics, and just kind of give people a sense of, when you're thinking about allocating a smaller portion of your portfolio to like high risk reward, high reward assets, like how do you kind of structurally define a framework to think about it and select those winners?
Oh, that's gonna be exciting for sure. I think that's count me in on that. I
Yeah,
would
we'll
love to
we'll do
do that.
that. We'll do that in subsequent.
I mean, put on the comment section if you
Whatever
would
you
love
want
to
us to
see
talk
that.
about.
Yeah, let
Yeah.
us know what industry you want us to talk about, what companies you want us to analyze. I'm not a guru, but Larry is a finance bro.
Hey, nobody
He's
is a
gonna
guru.
he's gonna bring out the models and show us, how to look at the numbers. But yeah, we'd like to see what you guys are interested in learning about. Like we said it at the beginning, we think we don't have enough voices in our community that talk about stuff like this. And we want to be want to represent you and share this knowledge with yourselves. So let us know if you've enjoyed this conversation and if you'd like to
You will sit back.
hear more. Yeah, feedback, please.
Maybe you don't want to see my face. I'll just turn on my camera and talk. You
Yeah, exactly. Yeah,
know.
cool. Nice chat,
No,
man.
yeah, this was great. We'll definitely do this again.
Yeah, sure thing.
Okay. Bye.
Bye bye.